The average 53-year-old American man has $87,000 saved for retirement. Not $870,000, 87. The median, half of men his age have less. And the thing is, he probably makes more money today than he's ever made in his life. He owns a home, he takes vacations, his kids go to decent schools. He thinks he's fine. That's the trap. Not being broke, looking fine while the hole gets deeper every single month. Here's what I'm going to show you in this video. The 4 financial traps that destroy the futures of men in their 50s, not because they were reckless, but because they were successful. Because the decade that's supposed to be your peak, the one where everything you built is supposed to compound into freedom, is actually the most financially dangerous decade of your life. And I'm going to show you the specific numbers that explain exactly why, because the math here is so far from what most men expect that most financial advisors won't even put it on a slide. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Before I get into the traps, I need to give you one mental model that's going to anchor everything in this video. And I'm using the word anchor intentionally. Picture a golden anchor, not a metaphorical one, an actual anchor the kind ships use. Massive, heavy cast iron. Except this one is gold, gleaming, impressive. People can see it from the dock and they know what it took to build it. Your mortgage is a golden anchor. Your fixed monthly obligations are a golden anchor. Your professional identity, your lifestyle, your car lease, your membership dues, your kids' tuition contracts, every one of those is a golden anchor you've dropped over the side. Anchors are supposed to provide stability, and they do, right up until the tide comes in. When the market drops 30% the year you plan to retire, when the job disappears, when the health scare arrives, when the divorce lands, your golden anchor doesn't protect you. It holds you in place while the water rises, and then it pulls you under faster than anything else could. The men who retire with real money and real options are not the ones who accumulated the most impressive anchors. They're the ones who quietly cut them loose while everyone else was still polishing them. Every trap I'm about to walk you through is a golden anchor you don't recognize as one yet. That's why they work. In a few minutes, I'm going to show you the retirement math that most financial advisors genuinely avoid showing their clients because the numbers are so far from what people expect that it tends to end the meeting. But first, let me explain the first trap, because this one is where everything starts to go wrong. Here's the thing about your 50s. Somewhere around 46, 47, a quiet psychological shift happens. The aggressive ambition of your 30s and early 40s starts to settle into something more protective. You stop thinking about what you could build and start thinking about what you need to protect. This feels mature. It feels responsible. It is also, when applied to the wrong things, one of the most expensive mental transitions a man can make, because you're not protecting wealth, you're protecting the appearance of wealth, and appearance charges rent. There's a concept I call the fixed obligation stack. By your 50s, most men have been saying yes to reasonable sounding things for 25 consecutive years. The mortgage you bought when rates were low, the second car, the vacation property you convinced yourself was an investment, the private school tuition you started when the kids were 8 and now can't reverse without uprooting their entire social world, the club membership, the subscriptions, the housekeeper, the lawn service, the insurance premiums on things you forgot you owned. Each decision passed a simple mental threshold. Can I afford this? And affordability to most people means the monthly payment clears the checking account. That's it. It's a cash flow question. It tells you almost nothing about wealth. Because affordability is how you end up with $3,000 a month in car payments on a household that should be building $3,000 a month in actual retirement assets. They look identical on a bank statement. They do completely opposite things to your future. Let me tell you about a man named Richard, 51 years old, regional sales director at a mid-sized manufacturing company. Makes $190,000 a year, more than his father ever earned, more than he thought he'd earn when he was 28. Richard has a $4,200 monthly mortgage payment, including taxes and insurance. A $750 lease on a BMW 540i, because he spent 2 decades earning the right to drive something he liked. A boat he uses 6 to 8 times a year that costs him $600 a month in financing and another $100 a month in storage fees from October to April. A country club membership at $450 a month, mainly for the networking. He'll tell you, and he means it. And 2 kids in private high school at $22,000 per year each. Before Richard buys a single grocery item, he is committed to $12,500 a month in fixed obligations he cannot easily exit. After federal and state taxes on $190,000, Richard takes home roughly $10,600 a month. He is spending more than he earns on locked-in commitments before he's made a single discretionary choice. He's not reckless. He's not irresponsible. He is the product of 25 years of saying yes to individually sensible things without ever calculating what they added up to. That number, $12,500 a month, that's Richard's floor. That's how much the world costs him just to stay still. That's another golden anchor. Actually, that's 12 golden anchors welded together into a chain, and Richard is still diving. Here's the reversal that most people miss. You think the problem is that Richard doesn't earn enough. The problem is that Richard's burn rate has grown faster than his savings rate for 15 straight years. His income doubled, his wealth didn't. Those are not the same thing. And your 50s are the decade where the gap between them becomes impossible to ignore. The American Psychological Association published research in 2024 showing that individuals earning over $200,000 a year report nearly identical financial stress levels to individuals earning $75,000. That's not because money doesn't matter. That's because the ratchet clicked. The lifestyle expanded to meet the income, and now both groups are running the same race on differently priced tracks. Here's the specific math on what that costs you. Say you redirected $800 a month, one modest luxury, one obligation you could have avoided starting at 40, into a low-cost index fund at 7% annual returns. By 65, that's $472,000. Not from investing more, from not buying one anchor. Now, for the trap that most financial planning completely ignores. And this is the one that turns a manageable situation into a permanent one. Stay with me, because this next part changes everything. You think the problem is not having enough saved, but actually the problem is not knowing what happens to whatever you've saved when the sequence goes wrong. There's a concept in finance called sequence of returns risk. It sounds like something academics argue about over bad conference coffee. It is one of the most financially destructive forces a person in their 50s will ever face. And I would bet that fewer than 1 in 8 people watching this video has actually modeled it against their own retirement plan. Here's how it works. Imagine you're 58. You've got $450,000 in your 401k. You plan to retire at 63. The market averages 7% per year over those 5 years, and you arrive at retirement with roughly $630,000. Clean, predictable. Now imagine a different scenario. Market drops 35% in year 1 of your retirement. Then it recovers and averages 9% for the following 19 years. The arithmetic average of your returns over 20 years still looks fine on paper, but you're withdrawing 4% per year, that's $25,000, while your portfolio is already down 35%. You're selling shares at a 35% discount every month during the exact window when your portfolio needs to be intact to compound forward. You're locking in losses repeatedly, and your money runs out somewhere around year 14 instead of year 25. This isn't theory. In 2008, retirement accounts lost a median of 38%. People who retired in 2007 or 2008 had their portfolios cut nearly in half. At the precise moment they became most dependent on them, the market recovered within 5 years. Their portfolios didn't, because they were drawing down through the entire trough. The sequence ate them. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now here's someone I want you to meet. His name is Gary. Gary is 54 years old, successful by any standard, and he's gonna follow us through the rest of this video because his story is, I think, more common than it should be. Gary has been with a major wealth management firm since he was 42. His advisor runs a standard 80-20 equity to bond allocation. Gary gets quarterly reports with charts he glances at and approves. He feels okay about his retirement. He knows he's not as far along as he'd like, but he trusts the process. Gary has $600,000 under management with this firm. His advisory fee is 1.2% per year. That's $7,200 annually. In dollar amounts, his statements never show him as a single line, just basis points, the kind of number that doesn't feel real until you compound it. 1.2% versus a comparable broad index fund at Vanguard or Fidelity charging roughly 3 basis points. The difference, compounded over 15 years on a $600,000 portfolio growing at 7% annually, is approximately $182,000. $182,000. That leaves Gary's future and arrives at his advisor's firm in quarterly increments, too small to register emotionally. That's not a management fee. That's a golden anchor on his return rate. And Gary's advisor has never once mentioned a Roth conversion strategy, which executed correctly over Gary's next 6 to 8 years, could realistically save him $60,000 to $90,000 in tax liability during retirement. It's a legitimate strategy. Gary's advisor knows about it. Gary's advisor has a structural incentive not to prioritize it because it involves moving some assets Gary doesn't need him to actively manage. Now, here's where Gary's story takes the turn that I mentioned was coming. This is where it gets really interesting. There are 3 things that hit men in their 50s simultaneously, and no financial plan I've ever seen actually prices all 3 of them in at once. Individually, each one is manageable. Together, they are the reason "I'll figure it out" becomes "I'm not sure I can retire at all." The first is aging parents. The average age at which American men begin providing financial support to an aging parent is 52. 1 in 5 Americans is currently doing it. We're talking about a generation, the baby boomers who largely undersaved for retirement, who are living significantly longer than their financial plans projected, and whose healthcare needs escalate sharply in their late 70s and 80s. Medicare covers hospitalization and some medical costs. It does not cover assisted living. The average cost of assisted living in the United States right now is around $5,000 to $7,000 per month, depending on location and level of care. If your parent has $70,000 saved, which is around the median for that generation, you've got roughly 10 to 14 months before the bill lands on you personally, every month, indefinitely. Gary's mother needed memory care last year, $6,200 a month. Gary's mother had $85,000 saved. Gary is now covering $3,000 a month on top of all his other obligations. That's another golden anchor Gary didn't see coming because nobody put it in his financial plan. The second thing is adult children. Not the cost of raising them, the cost of launching them. The average annual cost of a 4-year private university in the United States is now approximately $62,000 per year when you include tuition, room, board, and fees. $248,000 for one child's undergraduate education. If you have 2 kids, age 16 and 18 right now, you are potentially looking at close to $400,000 in post-tax college spending over the next 6 years. If you haven't been consistently maxing a 529 savings plan since they were born, you're covering the gap from current income, from home equity, or from retirement savings. Every one of those options has a real cost that most people don't calculate until they're already paying it. The third thing, and I'm going to say this plainly, is late divorce. Gray divorce, meaning divorce after 50, has doubled in the United States since the 90s. It now accounts for more than 1 in 4 divorces. And the financial consequences of divorce at 53 are not like divorce at 34. At 34, you divide whatever you've started to accumulate. At 53, you divide everything you spent your entire adult life building. Retirement accounts split. The house goes through a legal process that costs both parties money to resolve. Spousal support obligations in many states can run for years, sometimes indefinitely. The average documented net worth loss from a gray divorce for men is approximately 77%, not of an abstract number. of everything you built in a single proceeding, in a period of maximum emotional disruption when your judgment is at its worst. Gary, by the way, is currently separated. So now you have Gary at 54, advisory fees quietly compounding against him, sequence of returns risk unmodeled in his plan, $3,000 a month going to his mother's care, his eldest starting college in 8 months, and a divorce proceeding that is going to split whatever he has left down the middle. This is not a dramatic story. This is what happens when normal-looking financial decisions stack up without anyone doing the math on all of them at once. Financial advisors are great at optimizing individual pieces. Asset allocation, tax loss harvesting, rebalancing. They are rarely equipped and often not incentivized to look at the full picture and say, you have 6 concurrent cash demands coming, your burn rate is unsustainable, your fee structure is eating your compounding, and your plan has no sequence risk protection. That conversation is hard to have. It doesn't fit neatly into a quarterly review, and it might result in the client restructuring in ways that reduce assets under management. I'm not saying financial advisors are malicious. I'm saying the incentive structure doesn't always point in your direction. And understanding that isn't conspiracy thinking, it's systems thinking. Knowing who benefits from what tells you a lot about what advice you're actually getting. Here's a sarcastic but real thing financial advisors say. You're doing great given the market volatility. This usually means your portfolio is down, but so is everyone's, so your feelings are valid, and please don't move your assets. One of the most expensive sentences in personal finance. Now here's the 4th trap, and this one is the one nobody wants to look at directly. By 50, most men have a fully developed professional identity. You're known as something: the managing director, the founding partner, the guy who built the division from 12 people to 300, the entrepreneur, the expert everyone calls. That identity is real. It earned you real money, and it carries real social weight. And social weight, it turns out, is one of the most expensive things you will ever maintain. The neighborhood you live in signals your standing. The car in the driveway signals it. The club, the school, the watch, the vacation you mention in passing. Every one of those is a fee you pay to maintain the signal. And unlike an advisory fee, there's no disclosure document for this one. Nobody is legally required to show you the compound cost of a status signaling lifestyle over 20 years. Let me tell you about 2 men who graduated from the same business school in 2001. Both went into finance, both made similar money through their 40s. By 52, both earned around $220,000 per year. The first man, call him Paul, maintained what I describe as a prestige footprint. Correct suburb, correct car, private school, country club, the annual international family trip that runs $12,000 to $15,000 minimum. Paul looked successful in the common understanding of that word. He was also quietly drawing on a home equity line of credit to close the gap between income and lifestyle, a gap he hadn't acknowledged was there because each individual expense felt justified. Paul had $420,000 in retirement accounts and about $230,000 in home equity at 52. His liquid net worth, meaning the money he could actually use to replace income without selling his house, was around $115,000. The second man, call him Marcus, made different choices. Not deprived ones, deliberate ones. He drove a car he bought, used, and owned outright. He lived in a good school district, not the best one. He took one international trip every 2 years. He maxed his 401k from age 38 forward, hit the catch-up contribution limit the moment he turned 50, which in 2026 is an additional $7,500 per year above the standard limit, and invested $2,000 a month into a 3-fund index portfolio at a low-cost brokerage. At 52, Marcus had $1.2 million across retirement and taxable accounts. His mortgage was 60% paid down. His liquid net worth was approximately $950,000. Same income, same decade. One bought approval, the other bought options. And here's the darkest part of this story. Paul knows. He knows exactly what happened. He just couldn't stop while it was happening because every decision felt reasonable in the moment. That's not weakness. That's how the trap is built. The approval tax is invisible until you calculate it, and by then, you've been paying it for 20 years. Think of what you lose by not knowing this number. You lose the ability to walk away from a job you hate. You lose the option to take a pay cut for more meaningful work. You lose the capacity to say no to the promotion that requires 60-hour weeks. You lose the right to retire before your body forces you to. You lose the window where compound interest still has time to work in your favor. You don't lose these things all at once. You lose them one golden anchor at a time. Here's the mini case study. Two men, both 50 years old, both earning $180,000 a year. Man A has a monthly burn rate, meaning his fixed obligations before any discretionary spending, of $11,000. After taxes on $180,000, taking home roughly $9,800 per month, Man A is effectively running a monthly deficit before he buys anything. He's supplementing with credit, with equity draws, or he's technically breaking even while building no wealth. Man B has a burn rate of $6,000 per month. He's saving $3,800 a month. Over the next 15 years, at 7% average annual returns, Man A accumulates somewhere around $140,000 if he manages to save anything at all. Man B accumulates approximately $1.14 million. Same income, same market, same 15 years, 8 times the outcome. The only variable is the burn rate. At 65, Man B can withdraw approximately $45,000 per year under the 4% withdrawal rule. His Social Security benefit, based on 30 plus years of strong earnings, will be approximately $31,000 annually at full retirement age. His total retirement income is around $76,000 a year without aggressively drawing down principal. He can retire. He has choices. Man A has Social Security, same $31,000 plus whatever he scraped together, generating maybe $6,000 to $8,000 per year. His total retirement income is somewhere in the high 30s. His lifestyle required $11,000 a month. His retirement income covers roughly 30% of that. He works until 68, cuts everything he spent 20 years building, or runs out of money in his early 70s. This is not an extreme outcome. This is the median trajectory for an American man who earned above average income his entire career and made completely reasonable feeling decisions. You think the problem is the market, or taxes, or inflation, but actually the problem is the burn rate. Everything else is noise on top of that signal. Gary, by the way, I told you, he was separated, settled his divorce 8 months ago. He lost the house and approximately half his retirement account, bringing him from $600,000 to $290,000 in investable assets at age 55. 12 years to close a multi-million-dollar gap if he wants a retirement that covers his actual expenses. He's doing it. He moved to a smaller apartment, brought his monthly fixed obligations from around $9,500 down to $4,100. Switched his investments from the advisory firm to a 3-fund Vanguard portfolio with an expense ratio of approximately 4 basis points. Started Roth conversions converting $40,000 last year from traditional retirement accounts to take advantage of a lower tax bracket during this transition period. He won't retire at 62. He might retire at 68. But he's not going under. He cut the golden anchor. It was painful. He did it anyway. Here's what you actually do with all of this. 3 things. Specific ones, not generic advice. 1, calculate your personal burn rate this week. Pull up your bank account and your credit card statements. Add up every fixed financial obligation you have, mortgage or rent, car payments, insurance premiums, tuition, club dues, subscriptions you can't exit with one phone call, minimum debt payments, any ongoing financial obligation to a family member. That sum is your floor. The minimum the world costs you just to stay still. If that number exceeds 60% of your monthly take-home income, you have a structural problem, not a discipline problem, a structure problem. Budgeting doesn't fix structure problems. Eliminating obligations does. One of those anchors has to go. You already know which one. 2, stress test your retirement number against sequence of returns risk. Don't model an average return. Model what happens if the market drops 30% in years 1 and 2 of your retirement and then recovers. Run that scenario against your actual withdrawal rate. Most online calculators don't do this. The one I built does. It's in the description. If your plan only survives a straight line positive projection, you don't have a retirement plan. You have a prayer dressed up in spreadsheet formatting. 3, audit every fee in your financial life this quarter. Advisory fees, fund expense ratios, insurance product loads, anything you pay for financial management. If your total annual cost of investing exceeds 30 basis points, that's 0.3%, you are overpaying. The difference between a 1.2% advisory fee and a 3 basis point index fund, compounded over 15 years on a $500,000 portfolio, is over $160,000. Not a footnote, a retirement income stream. It leaves quietly, quarterly, in numbers too small to trigger an emotional response. That's why it works. That's why you have to go looking for it. I've been running my own business for over a decade. I have hundreds of thousands of dollars in the market. I've sat in rooms with accountants and tax lawyers who showed me how money actually moves when no one is performing for a camera. And the pattern, consistently, is this. The men who arrive at 60 with options aren't the ones who earn the most. They're the ones who calculated their burn rate, identified their anchors, and had the tolerance to cut them before the tide came in. Most men don't. Most men polish the anchors right up until the water is at their chin. Not because they're foolish, because every anchor looked like an achievement when they dropped it. And achievements, psychologically, are extremely difficult to classify as liabilities. That's the trap in its purest form. Not ignorance, not laziness. The collision between how something felt when you built it and what it's doing to you now. Lazy investing built more fortune than crypto memes. Because lazy investing means index funds, automatic contributions, low fees, and doing nothing clever for 30 years. It doesn't make you feel smart at dinner parties. It doesn't give you a story about the thesis you nailed or the sector you called. It's embarrassingly boring. And it works. The men still grinding at 67 in jobs they're too tired to enjoy are largely the ones who looked impressive at 52. The ones who retired early and don't talk about it much are the ones who cut the anchors, raise the savings rate, and let compound interest do what compound interest does when you don't interrupt it. The window between now and 62 is not as large as it feels, but it's real, and it's yours.